Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest episode of InvesTips from the CIO's desk. Today, I want to talk about the investing in real estate. In particular, the role that real estate investment trusts, or REITs, can play in your portfolio. Now, for many people, the law of owning property is very strong and something that is handed down from generation to generation. This often starts with owning your own place to live in. Now, owning your own apartment or house naturally comes with costs, but it also comes with a sense of satisfaction that your monthly mortgage payments are going into acquiring an asset that has historically risen in value rather than just paying it out in rent. It also comes with the fact that you do not have to move for the foreseeable future, which creates huge comfort for the family. Now, for many, owning your own place is not the end of the love for real estate. Many people also are keen to invest in property to create an inflation-protected passive income by expanding their real estate portfolio. However, and I can personally relate to this approach comes with many challenges, such as the property management issues, a frequent turnover of tenants, maintenance costs, and concentration risk, where the market dynamics change, making the rent you achieve very different, higher or lower, than expected at the time of the purchase. And I can promise you, my wife and I have experienced all of these features over the course of the past 10 years. So what is the alternative? Well, this is where real estate investment trusts, or REITs, can come in. REITs are the stock market version of owning real estate. Like mutual funds, they pool funds from investors and either invest in properties or finance realty projects. The returns are generated in the forms of capital gains, rental income, and these are passed on to you as dividends and capital appreciation. Typically, REITs are mandated to pay out 80 to 90% of income in the form of dividends, and this can be a tax-deductible expense for the company. So REITs lend a unique angle to your portfolio. They're an excellent dividend-yielding instrument, but they do suffer some drawbacks, such as the possibility of a longer down cycle and extreme drawdowns, as we saw during the pandemic. Meanwhile, while a REIT is more diversified than owning an individual apartment or building, they can often be very focused on a specific geographical area or sector of the market. Therefore, it's important to understand the underlying assets owned by a REIT and to get a sense of the potential volatility of both rental income and, of course, of the REIT's price itself. Now, one common driver of REIT returns is the level of interest rates and bond yields, as not only are bonds a potential competitor for yield-hungry investors, but REITs also generally borrow money to acquire their assets, and therefore rising yields can increase the cost of that borrowing. On the other hand, though, by combining a variety of REITs across geographies and sectors, for instance, office, residential, hospitality, and retail, you can achieve a diversified source of income that should be inflation protected over the long term. Therefore, REITs can form an important part of an overall investment portfolio, especially for investors who have need for income to fund their expenses and are less concerned by price volatility. Thanks so much for joining us today. I hope you found this both interesting and useful, and I look forward to catching up with you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.